That's saying recording. Fantastic. Right, I'll just say good evening again. So good evening, everybody. We've just started recording, and let me start with sharing a screen. So I, as always, have prepped a little PowerPoint. I think it always helps just to keep me on track. And we've got a few things we're going to talk through tonight, and then I'm going to answer a few little bits and bobs at the end, which are questions which have come up about Facebook. On Facebook, sorry, about certainly ratios, gold silver ratios, and why I'm pro silver at the moment, vice gold. I guess I talk about things like that sometimes a little bit too flippantly, assuming that people understand it. But of course, because I've been looking at it for so long, I kind of understand it, and that's my own fault. I should actually not assume knowledge. So we'll go through a worked example of why I play a ratio at the end. A couple of things tonight. You know, I like to do these as an education piece, because what I think is it's pointless just harping on about certain shares, this, that, and the other, because we can all sit and do that. But if you don't learn some of the basics of education and understand some of the basics, then actually it makes the learning, which I hope to move on to in a number of weeks' time, far harder. So I'm going to cover two basic concepts tonight. In fact, let's do this first, really. And I wanted to cover this first. AIM stocks, IPOs, and FOMO, right? Few posts have been going up in the paid Facebook page about, you know, little things like this. Now, this isn't a criticism whatsoever, but what I'm getting at is I want people to really understand the difference between AIM stocks and IPOs. So an IPO is an initial price offering, and an AIM stock, in the United Kingdom, there are two main stock markets, okay? There is the FTSE there's three technically. There's the FTSE 100, there's the FTSE 250, and there's the AIM market. So the FTSE 100 is the top 100 companies within the United Kingdom. The FTSE 250, the common misconception is, so FTSE 100 goes from 1 to 100. The FTSE 250, the common misconception is the FTSE 250 is 1 to 250. Well, it's not. The FTSE 250 is 101 to 350. Okay, so that's the 250. It's the next 250. And then the AIM market, which is called the alternate investment market, is kind of small cap shares, the ones who haven't made it into those sectors yet. Now, a lot of those are small exploratory companies. So you'll get gold mining exploration companies, you'll get oil exploration companies, those sort of things. Some companies will make it, some companies will go bust. Many of them are penny stocks. Now, many of them, because they are in that exploratory field, when they hit things, when they hit what they are exploring for. Now, this was just out the Facebook group. I put it up here more as a reminder. When they hit what they're exploring for, their price will hit the roof. It will shoot up by 50, 100, 200% overnight. Okay. Now, if you are in that, well done. Okay. But for every one that does that, there's 100 that don't. So when you see, again, on your social media posts and things like that, and people saying, have you seen this company here? You should be investing in that because it's just done 1,000%. Correct, it has, okay? But that's like picking a needle in a haystack. There's 100 others that have got charts which have gone rapidly down and hit the floor. And let's not forget that if a share loses 50% of its value, in order to get back to break even, you have to then get 100% gain. Yeah. And that's something that people do miss as well. So let's say you are at £100 and your AIM share drops to £50. In order for you to get back to break even, it now has to make a 100% gain. Okay. So if you enter into that at £50, you are then looking for, you know, a 20% gain for you at £50 is good. But for that person who's gambled on the AIM market where they are so volatile, then actually you may stand to lose. So all I'm getting at is, don't always be, you know, you will always see some mass movers in the AIM market. It's very much like doing crypto. You will get massive moves. I'm a great fan of them, but you've got to do it properly. So and the way to do an AIM stock properly is you will look at a sector. So you would look at, for instance, let's go oil exploration companies or gold exploration companies. And you would basically put 100 quid or £50 or £10 in 100 of them. Because one of them will probably hit, but 99 of them will probably lose. But the one that hits will probably have it will have more than 100x potential. Okay. So therefore you are, but it's a very, very risky sector of stock trading. Okay. And you're very much trading rather, even though you own the shares. Again, a question that was asked is, what's the difference between trading and stocks? Okay. So when I refer to stocks and shares, I refer to ownership. That's where you're physically buying an element of that company. When you are trading, you are not, you are betting that the price will rise or the price will fall. Now, when you trade a share, so when you are using spread bet accounts, when you spread, that's you're trading. The winnings that you make are not coming from the company. The winnings that you make are from all of the other people who've shorted the market. So say you go long and you make £5 per move, per pip. Your money comes from the person in whether you're using IG, FXCM, AxiTrader, your money comes from the person who's put £5 per pip going short. That's where the money comes from. It doesn't come from the company. You have zero ownership of that company when you are trading, and hence why it is tax-free. Guys, tonight, when I'm talking, instead of putting comments in the chat, please just take yourself off mute and ask. So if I'm losing anybody already, please take yourself off mute and ask. So what I'm saying there is, I've lost my train of thought. Totally lost my train of thought.
Difference between trading and stocks.
Trading and stocks. And the reason trading, and so trading is tax-free. And again, people have asked me this week about the tax-free element of that. When I refer to that being tax-free, that's because it is classified as winnings. Yeah. Trading, spread betting, okay, spread betting is trading. When you're spread betting an item, that is winnings. You have won, you have gained. Now, that is the only tax you would ever pay on stocks and shares or anything like that. It's not income tax, it's capital gains tax. It's your CGT element. Now, capital gains tax on traded income, it is void capital gains tax. So if you take that out and then use that as your income, you are void tax. Irrelevant if you're a high rate taxpayer or anything like that, because it is capital gain, yet traded income is void capital gains tax. Now it's if you just literally Google spread betting tax-free, you will get the HMRC reference to that. But it's a very, very common thing. It's because HMRC classified spread betting as void capital gains tax. But that's my little bit about AIM shares. Be very careful dabbling in the AIM market. Be very careful by you getting FOMO when people are posting things. This one wasn't the case, but I see a lot of others who will post, check out what I've done today, my £3,000, my 3,000% gain. Okay, it's very easy to take a screenshot of one of those things and post it on social media. It's an area that I will not be delving into, okay, at all, because I don't. If I do, then I'll explain exactly why. I have bought AIM shares before, but you've got to be very, very careful. There's nothing wrong with buying AIM shares, but buying the penny shares and the speculative shares, you've got to really know what you do. IPOs, right? IPOs at the moment are going wild, okay? And what I mean by that, IPO is an initial price offering, and I'm just going to come out of this. And there's a Bloomberg article, which is probably worth you all. If I can exit my... Oh, well, this is from the Bloomberg article. I was going to show you it live. A good Bloomberg article, which is effectively, again, showing that how IPOs are currently creating the new billionaires in China. Okay, and they're the sectors that it's currently doing it in. So healthcare and tech are obviously the two main ones. Just Google that headline into Bloomberg. Very good article to read, written on the July the 23rd about IPOs. We've got some very big ones coming. Obviously, you've got your Airbnb, which has hit the press massively, and there's a few other ones which I will be keeping an eye on as well. But I will advertise that in the Facebook group. But just have a little read about that, because again, IPOs, the initial price offering when a company first comes to the market, it can be a very, very volatile period. But again, don't just follow the sheep and don't just have FOMO in it. You have to critically understand what the company is about and where the company's making money. So Airbnb, for instance, if you want to invest in the Airbnb IPO, and again, I'll do a little bit of research, and if I elect to do it, then you will certainly know about it in the Facebook group. But if I don't publicize anything, please go and have a read yourself. Don't just think, I've heard of Airbnb, everybody in the world's heard of Airbnb, everybody's using it more, therefore it's going to go up. Actually look into where Airbnb makes the money, because it's not where you might think in just renting rooms. You've got to critically look at where that company physically makes money. Is it in advertising? Is it in the meeting of the owner of the property and the person who's going to rent it for the weekend, etc., etc. It's actually in advertising if you wanted the answer. So Airbnb make their money in advertising, not in the renting of a property out.
They've pivoted, haven't they, as well, to start doing experiences. I was looking at that the other day.
Yeah, but advertising is still their major income. So, current holdings. We're going to talk about this. Boohoo, right? So I think Boohoo's. So like I put in my little thing this morning about Warren Buffett. He's still picking stocks at 90 years old, wanting to see them grow in the next 10 years. Yet people worry when a company like Boohoo drops by $4. I set up this group to promote wealth education, not quick ins and outs and quick ins and outs. Now, Boohoo, where it stands, yes, it was at 330. It's down to, I think, 280. Obviously, it hasn't traded today, being a bank holiday. The allegations that came out last week were in a Guardian article, referenced the minimum wage. Now, there's a lot when you read into that. There weren't Boohoo factories. They were actually third parties' factories. They were Boohoo's own auditors who found the issues, because actually Boohoo had called for that investigation into some of the factories that they were subcontracting that out to. A lot of the workers hadn't clocked in and clocked out. Therefore, obviously, it's hard to clock hours. What I'm getting at is it's a classic case of press making the story fit what they wanted to fit. Now, Boohoo have promised an investigation update on the 30th of September. And that is the same date that they released their next financials. Now, Boohoo have done very well. So that is a date for everybody who's got money in Boohoo. Now, Boohoo have done very well over lockdown because obviously the online shopping piece. And I think the coordination of both those things on that day will mean that between now and the 30th of September, I can actually see that price trickling lower. Okay. So from where we are, I see that trickling down. The fundamentals of that company have not changed. They've got virtually zero debt. They've had year-on-year increases on their revenue, year-on-year increases on their profit. Now, if those investigations come back and prove categorically they knew about it and they were involved in slave labor and they were doing this, obviously that is going to have a huge effect on the company reputationally. But financially and fundamentally, they are still a very, very solid buy. However, I do see them dropping for the next month until the 30th of September. What will I be doing? I won't be selling. Okay, I may cost average in. However, I'm also running out of funds in my accounts to do that. So I've got to look at where I want to allocate funds. So I may not cost average. My initial purchase on that was 220. Okay, so I'm actually still in profit. I did buy a few more, but I know some of you may actually be going into negative territory now. It's nothing, do not be trying to sell and then buy back at a lower point. This is one of those shit, and it's critically important to understand why you're getting into these things. You're getting into them for the long-term future of these companies, and Boohoo certainly has a very, very positive long-term future. But that's what my prediction is, that we will continue to see it trickle down. So if you haven't got the nerves for that, potentially you should question share investing in the first place. Because as old Warren says, I think I've got his quote up. I expect to take a flat line. Yeah, but you've got to understand why you get into it and the fundamentals. But as old Warren, and I love a bit of Warren Buffett, the bloke's 90 and he's still picking them like there's no tomorrow. As he says, you've got to be able to weather the downs as well as celebrate the ups. But if the fundamentals have not changed, which categorically the fundamentals have not changed, and the company's debt level is good, Boohoo has virtually zero debt. By jumping in and out of the shares, nothing's changed. It's a way of transferring wealth from the inpatient to the patient. Okay. So that was one. Arrow seems to, again, get you guys all a bit hot under the collar. It's done some amazing moves, okay? Amazing moves. And chances are it will have a pullback. Sit with it. Okay, sit with it until it hits a target. Now, if you're not if you're not comfortable with the targets of where I personally set them, set yourself another target. And when I say set yourself another target, if your target, say with Arrow, maybe let's call it 120, you could set yourself an interim target. So I set that 150, those remember. You could set it at 120. And at 120, what you could do is you could profit take. And what I mean by that is sell half the position or sell a quarter of the position. So that's called profit taking, and it's selling a portion of the position at another sub level down from the target. Target 150, you actually, and bear in mind that it won't just go from here and climb and climb. It will sawtooth like so. So one day you will look at it and you'll think, wow, I'm 30% in profit. Next day you'll look at it and you might only be 15 because it's subsequently dropped. You've got to really learn mentally to be able to deal with that, okay? If you feel that that's potentially too much for you at the moment, then set that interim level. Set that potentially 120 is where I potentially say to you guys, do it, but profit take, okay, from that point. Rocket Holdings getting a hell of a lot of press at the moment. It's actually dropped a wee bit today. I think it was about 0.2% in the end there where it's closing up. It got down to about 2.5%. So their figures are up on Wednesday. Okay, a lot of the big players are now putting price targets on that. $35 seems to be average. That'll be an interesting one Wednesday. Okay, so on Wednesday, if that spikes high, very aggressively high, I will probably sell, even if that's not at the target figure. And the reason being is it's getting so much press at the moment that it could have a completely vertical climb to a very, very low. It may be a complete flat pancake and do nothing. And at that point, I still feel it's quite a hold. But let's say those results come in on Wednesday, because I'd like to think, just because I've said it, I'd like to think that a lot of you have gone and looked away what Rocket Holdings do. Okay, so you've got to look at the figures that they're worth, their debt levels. Okay, so what that company is worth is about 1/5 of the value of Amazon. Yet you look at the two share prices of $29 versus Amazon's share price. The things don't represent. Rocket is one of the biggest mortgage or lenders currently in America. And obviously it's just had a massive boom period. Do I want to hold it long term? Okay. To be honest, no, I don't. Why? Because I see the default rate, which is already right, default on loans in America already going up, and I see it continuing to go up. But that's for another day. All I want to cover off at the moment is Wednesday. If I see a massive spike on Wednesday, let's say a 20 or 30% rise in that day, I'll probably get out. And I'll post on the group.
Company, what time could we expect to see that announcement made on Wednesday? Do you know?
I haven't looked, to be honest. I haven't looked at the time. I think it's after hours. So it's after trading hours, which is quite often what they do. So that if it's bad, people can't then sell to them. So it will do what's called gapping down when it opens. It's kind of a play they do. I think it's after hours Wednesday rather than after hours Tuesday into Wednesday, if that makes sense. I'll find out. I did read an article about it today and I'll drop it in the group. Norwegian Cruise Lines. The cruise line sector, cruising's starting again, actually. That's a longer term hold, if I'm honest, as is Lloyd, as is BP. I was asked the question, do I prefer value stocks over dividend stocks? Growth stocks and dividends, difference being. So BP and Lloyd's were fantastic dividend holdings. But why I wouldn't necessarily chase dividends at the moment is because most of them have been cut drastically, if not altogether to zero. So I'd probably reevaluate dividend holdings in maybe 12 months' time. But Lloyd's and BP for me are just long-term stalwarts. NCLH, which is Norwegian Cruise Lines, the cruise line sector is not going to die. Cruising will come back, and I still categorically believe that. It's hovering. I think I bought about 14. It's hovering around $16 now. At 20, I think I put a target of 21 because I was hoping for a quick little buck on that. But actually, it's got a lot more legs in it. If you bought into any of the cruise lines, I know if somebody else on this call got into Carnival. There's 3 of them really. There's Carnival, Royal Caribbean, Norwegian Cruise Lines. I do see one of them going bust. So you've got to and obviously I don't see it being Norwegian because that's the one that I recommended. Why? Because again, their debt levels are the lowest, so they can weather the storm for longer. But I do see one of them probably going under. Yeah, I wouldn't like to hazard a guess at which, but I do see one of them potentially going under. So that's
it's great though for market expansion for them though, isn't it? If one of them goes, if one of their competition tanks.
Yeah, I can just see it happening. I feel the sector closing down completely to hold. Saying that, mind, have you seen the Virgin cruise liners which are sat alongside in Miami, which they've just had built? So they've got some brand new ships which are sat alongside in Miami. Now, obviously, old Branson's having a hard time with it at the minute. So who knows? They aren't really an operating player, but that might be an interesting one.
They might dispose of them cheaply, though, which is a great way.
Well, that's exactly it. Yeah, that is exactly it. So that was my holdings until this afternoon, and I bought into Tesla. I bought in at the split. It's already gone up 10% today. Why did I buy in? I just see a massive spike. I see a massive spike. I see all of those. Would I buy in tomorrow morning? Probably not. So as I posted that in the Facebook group was literally as I was buying in. The market opened at 2:30 today, and I just was like, fuck it, I'm buying in. So because I thought every retail investor is now going to jump on it, and I think it's gone up. I think it was 10% at the last time I looked, just prior to this. Yeah, 10.6%. It's gone up $47. Why? Because that's everybody piling in. That's all of those little players jumping in the market. And even though I don't like playing that game, I just couldn't resist it. I couldn't resist it. I thought, oh, go on, I'll have a little bit of it. Now the question is, will I sell it? Do you know what? I don't think I will. I don't think I will. And the reason being is I had FOMO massively when Tesla was $400 in March. And I did not, nobody saw it doing what it was doing. Now, do I think it'll continue doing what it's doing on this vertical trajectory? If I'm honest, I can't see how. A stock split does not create more value in the company. So actually a stock split, now bringing the price down to $400, $440, I think it is, you have created no more value in that company. So what you're doing is you're creating a bubble. So the price will go up, but why? Because people are jumping in. And it's the point at which this is generally when you will then get the big players profit taking. Okay, so it is a very kind of standard play. But I thought that would have happened before, and it didn't. So I threw some money in there today into Tesla, and I'm just literally going to park that. That's in one of my child's ISAs, and that's it. If that halves in value next week, I'm tough. I'll maybe cost average down to it. But because I suffered from FOMO in March, and I never ever saw Tesla doing what it was doing, and I just look, you've got Battery Day coming up. You know, he's not a car company. The bloke, he's probably going to be the first trillionaire. You know, you saw that thing about his the neuro bit he was doing. You know, so which is scary if I'm brutally honest. But I don't see him stopping. He's so innovative in every field that it's not going to stop.
Did you see that? Did you see that article about the new battery someone's created?
Someone's creating?
Yeah, so you don't need to charge it. It's utilising radioactive waste carbon rods. They found a way of making them safe by coating them in carbon, and basically you'll have a phone that you never need to charge.
But it's radioactive.
No, it's not, because it doesn't emit anything. It decays, but it's protected by a surrounding coating of carbon, which protects it from emitting anything.
Oh well, there we are.
Mm.
Right, that's a call up. Right, I want to quickly talk to you. One of the basic fundamentals of UK, and again, this one, hopefully this will be a bit of an eye-opener to a lot of you. A lot of you will probably heard the term. The term's not used anymore in the UK because everybody claims that the UK don't do it. Everybody claims that the Western world don't do it. Yet you go on the Bank of England website and it categorically says this is exactly what the Bank of England is still doing, yet they're not allowed to use the term fractional reserve banking, but it clearly is fractional reserve banking. So what is, I just want to, this is my education bit, and I feel it's important that people actually understand how banks work. Okay, so when we're talking about the banking sector, it's very important. Fractional reserve banking was one of the reasons that of the financial crash back in 2008. Things have changed since then, and we'll talk about the changes we go through. But actually, I don't think many people actually understand how banks work, and it's about this fractional reserve. But as I said, they don't use that term anymore. So what is fractional reserve banking? So it simply works. So it's more than notes and coins, okay? So if you've got a bank account, you can go ahead, and I'm going to do this as a story, okay? And I've put some inventive names in my story to try and make you remember as it goes along. But effectively, you can use a debit card. It's not physical cash, okay? And you can go around and you can buy things, okay? So we think of this as money, even though it's not cash, okay? And I think that's quite important, again, when we're moving into digital currencies and things, which I'm very, very pro on, and we'll talk a little bit about at the end. So if you borrow £100 from the bank, it credits your account with £100, yeah? So if you're borrowing it, then crediting it to your account, it credits that, and that's known as new money, okay? That money didn't exist before, but it's now being credited to your account. They've put some zeros on the end of it. It also means that if you pay off a loan, the electronic money in your bank created is then deleted. It no longer exists. And this is, it's this concept as well. This isn't fractional reserve, but this is just banking. The more and more this is done these days, and especially with what's just gone on with the old coronavirus, where we're now all using moneyless transactions, it's all just zeros on a computer screen, okay? And the Bank of England will openly publicise that 80% of money in the economy now is just electronic deposits. Yeah, that is the diagram, which is from their website. So 3% is only in notes and currencies, 18 in reserves. That's fractional reserve banking, which we'll come on to in a minute. 79 are deposits, zeros on a screen. And people think we're not going to go to a digital currency. You know, it's imminent. In fact, you know, the Fed's already doing it. So that's the basics there of the banking. So modern day banking, very, very simplified. So don't say to me at the end, but Richard, if this happens, then that happens. This is the simple terms. This is as simplistic as it can possibly be. And there's 1,001 other inputs that make current banking not as simple as this, but this term, I think, will shock a number of you on the call. So banking obviously goes back a long, long time ago, okay? And obviously we know about the gold standard. And we're mentioned about the gold standard a number of times. Now, since the gold standard was eradicated within the world, okay, and we went on to the reserve currency of the dollar, which I think is a very, very interesting point for another day, we moved into the modern day banking sector. So in the most basic sense, banking, we take money from deposits, we pay interest, the money's then lent out, okay, and it receives interest. As long as the interest received exceeds it paid out, everybody is happy. And it's that reason why banks at the moment are in the doldrums, they're in the gutters, okay? And it's why long-term, I've got Lloyds, which is the only bank I have, long-term, interest rates will go up. They will have to at some point, which actually makes the banking sector's profits, will increase the banking sector's profits. Somebody give us a thumbs up if that's still making sense. That should be, yeah, happy. Happy, happy, happy. So that's how banks ultimately make their money, okay? So reserves had to be kept in banks. Now, back in 08, or prior to that, the reserves were dwindled away and dwindled away and dwindled away. And hence what you'll see in a moment is one of the reasons, one of the catalysts that forced the banks to fail, okay? Now at the moment, the reserve is set at 18%, but those of you who've heard me talk before, I've said that I do see a bank failing in the next few years. And this is basically the reason why. I think it'll trip up on fractional reserve banking. And you can almost see that in some of the share prices. So what is it? Okay, so fractional reserve banking, the reserve requirement's 18% in the UK. So a bank with £100 in deposits has to maintain 18% in reserves. So let's say I have £1,000 and I put that into my Lloyd's bank account. Take my grand into Lloyd's. 18%, okay, £180 has to go into the back room. Okay, only £180. Yeah. £820 gets loaned to Hugh Jarse, okay, who uses it to buy a car. The seller of that car, Norma States, deposits that £820 into her savings bank account in Lloyd's. Yeah. So 820 is now gone back to the bank. Lloyd's now places £147, 18% of 820 into its reserves, and now lends the remaining 673 to Dixie Normus, who uses it to buy some clothes. The clothes seller, Seymour Ships, decides to keep the cash, put it in his pocket. So let's see what's just happened. Yeah. My original £1,000 that I put into Lloyd's has started a chain of events. But there's now £2,493 of cash in circulation. There's me with my £1,000. There's Norma Stitz, who put £820 into a savings account. And there's Seymour Ships with £673 in his pocket. That is fractional reserve banking. Okay. Now, when it's used like that, everyone's happy. The bank's just created money. Yeah. But let's see how quickly it can go wrong. Okay. So it can go very wrong when I want my £1,000 back. Okay. So I go to Lloyd's and I ask for my £1,000, but they've only got £327 in reserves. Okay. As I've said, it's simplified. We all know that there's reserves from everybody else, etc., etc. But this is simplified. This is a single case. There's only 18% of the reserves, i.e. 18% of the deposits, the 1,000 and the 820, which totals 327. So I'm asking for my 1,000 back. Lloyd's have only got 327. So the banks have to call in their loans. They cease further lending and they start calling loans in to meet that withdrawal. And that's when it gets bad. Okay, if the bank is unable to call in those debts or to meet the withdrawals, it may be classed as insolvent. Panic ensues, etc., etc. Let's roll back a la Northern Rock. Those of you who remember those queues outside of Northern Rock, everybody was asking for their money back. Okay, let's see what's changed since that point in time. The 18% reserve wasn't enforced then. And also there's the £80,000 insurance guarantee. But fractional reserve banking in its purest sense that I've just spoke about there still happens in this day and age. Okay, it's not called fractional reserve banking, but the 18% reserve, exactly as I've just spoken about there, still goes on. And I think that's a concept that not a lot of people understand about banks. Okay, but it's a very, very important one that everybody really should understand when you're putting your money in the bank. What's physically happening to that money? Yeah. So hope that makes sense.
What was the limit prior to the crash, or wasn't there one?
There wasn't one.
Right. Okay.
There wasn't one. So hence why a lot of people lost a lot of money. Yeah, and I think it sits at what's £86,000 now in a single account, but there wasn't one prior to that. So it's one of those things. It's one of those classic things of you don't know what you don't know, or you don't see what could go wrong until it goes wrong. And it's one of those classic lessons learned. Nobody saw what was happening then as happening. Then it happened. And then all of the lessons fell out of the back end of it, i.e. the level of reserves that were held in the banks, the level of money that people could withdraw or needed insuring. So all of those lessons fell out of the last financial crash. Now, obviously that was based on subprime mortgages, which is why it started collapsing in America. And this isn't why '08 happened, but it's one of the lessons that fell out of it. Okay, but because it still goes on today and it's the way the banking sector is still run, I wanted to cover this tonight to really show you, well, it's a lesson. Okay, I'd like, you know, I dare bet there's a lot of people who didn't know that's how banking ran. That was my education point number one. The second one I wanted to chat about, analysing companies. This is this is just this. Have I got the three basic? Okay. Hold this slide till the end. Okay. So I want to talk about bubbles first, right?
Rich, I watched The Big Short the other day. It's quite good to watch again when you have understanding of what they're doing, because it actually explains it all and you can follow it from.
Very good film. That's a really good one. Too Big to Fail is another good one as well. Too Big to Fail, I think, is on Amazon Prime. That's worth a watch. But yeah, The Big Short's an interesting one. In fact, I'm going to talk about old Murray at the end of this tonight. Who's the fella from The Big Short? Anyway, talk about bubbles. I want to talk about a quick one about this. Now, this came from, this is again from some analysis from the book that I've told you all to read, which is Principles. So there's been plenty of talk at the moment in the current environment about a bubble. Okay, about a bubble. Guys, you're going to have to sit tight. I'm just going to grab my laptop charger from the other side of the room because I thought it was plugged in here. Sit tight. Who's that? Right, we're safe. I'll turn around a wee bit, however. Plug it into the wall. Who's drawn on my screen? No phallic members, you Martlows in the room. Right. Right, we're on. Bubbles. Right, plenty of talk about current environment about bubbles, both market bubble and property bubble. I just want to make sure this is. I can't see if it's charging up. There's a few little factors about this, which again, once you all understand, you'll start looking for them. It's like law of attraction. We've all heard about the law of attraction. A lot of you will have read the book The Secret or seen the documentary The Secret. Once you read something or understand something and put that thought in your head, you'll start seeing it a lot more. And it's not that it wasn't there before, it's just because your attention's been drawn to it. So it's like that classic case, if you're looking for, say you've never seen a Mini Cooper on the roads and you think, oh, do you know what, I'm going to buy myself a new Mini Cooper because nobody's got one at the moment. And all of a sudden, next time you're out driving, you'll see 1001 Mini Coopers. Or it's like, I want to buy a red car because I haven't seen anybody with a red car recently. Next time you're out, you'll see 1001 red cars. That's just the law of attraction. It's not that they weren't there, it's just because your mind wasn't focused in on that subject. So by putting some little seeds, by putting what I'm about to tell you in your head, actually you'll start seeing the signs a lot more. So whenever I say the writing's on the wall for certain things, it's because I understand what the signs were and I see them potentially a lot more than others because I understand them. And hopefully you will very shortly. It comes, as I say, from the classic signs of the bubble, which is the framework from Ray Dalio. So he said, number one, prices are high relative to traditional measures. PE ratios, those of you who've heard me talk about the price to earnings ratios, are high for their relative sectors. Remember why I wasn't buying into Tesla? Because its PE ratio was through the roof, okay? Generally in a sector, you want a PE ratio of sub 10 to make it a cheap stock. But the prices are relatively high. So that's sign number one, yeah? let's look at the S&P 500, and that's currently the S&P, so the whole S&P 500's PE ratio. Okay, so if we look at the timeline there, at the bottom, it started to climb, didn't it? Look at that, 08, it started to go through the roof, and that's where it is at the moment. So it is on the way up. It's not record high, but it is climbing from where it's been for the previous period. So do we think sign one has been satisfied? Probably not categorically, but there's a little marker there, shall we say. Sign two, broad bullish sentiment. Stocks only go up, everyone's staying. Property only goes up, okay? It's become a mantra between tweeters. So I spend a lot of time on Twitter, like you know, where I get a lot of good info from. People are live streaming YouTube videos, social media posts, not only about stocks, but about the property market, okay? For those people who are saying it only ever goes up, don't get me wrong, it's gone up more than anybody ever anticipated, but everybody's talking about it right now, okay? Okay, so sign number two, would I think old Ray's got that one right? I'd probably say sign two is there. High leveraged financing. What's everybody doing right now? Everyone's borrowing to the hilt. Overall economy debt levels are absolutely blooming. However, personal debt has shrunk. Personal debt as a result of the pandemic has shrunk. A lot of people use that to draw down their own personal debt, which is quite an interesting thing. And to be honest, quite sensible. I didn't expect people to do that. But we're looking at the stock market now, but it also applies to property, that people are very highly leveraged, highly geared. Yes, interest rates are low, but they're very highly geared at the moment. And hence made a lot of forward purchases, speculating, buying property with bounce back loans, buying shares with bounce back loans. Don't get me wrong, I've used mine for things like that, but I understand it potentially a lot more than others. I haven't just jumped in with both feet without knowing about it. But speculating with money that they haven't potentially got, taking out credit card loans to purchase things that they speculatively think will only ever go up. Buying Tesla because you got FOMO and jumped in today, okay? Yeah, but you get what I'm talking about there, speculatively. I talk about speculation, top of the triangle. This is a different type of speculation. Next sign, new buyers have entered the market. Okay, Robinhood, for people who haven't heard of Robinhood. Robinhood is like a share trading app, like 212. 212 is probably its closest rival. 212 share trading that some of you use. But Robinhood is an app very much it was very much American based, and it's now one of the most used apps in America, and it's seen the most new downloads, and most of the deposits, the new deposits that have gone into Robinhood are around $1,200, all at around the same time. So what the stats are showing is that thousands and thousands, if not millions of people in America are all depositing their social security checks into a share trading app because they think they'll get rich off it tomorrow. Because obviously they all got helicopter money in America of $1,200, their social security checks. So a lot of people have downloaded Robinhood app, they've thrown all of that money in there, and obviously they now want to multiply it. Why? Because everybody decides, let's go and do stocks, let's go and do this. Yeah, a lot of people are talking about it. Okay, what's the old adage when you hear the taxi driver talk about something, or you get the advice from the taxi driver? That's the time to exit it. So, and don't get me wrong, I would say 90% of you guys are probably new to it all as well. But I'd like to think, because you're taking a little bit of advice, and I'd like to think that my advice is better than the average, then at least you're doing something. You're not just going onto a social media platform. Twitter's the most damaging when it comes to share pieces if you don't know what you're looking for, and throwing all of your money in there and throwing all of your speculative, let's roll back to sign number 4, speculative money into it. My social security check thrown into a Robinhood app and thrown on the stock market. Okay, sign number 5. Property market's exactly the same. The amount of underanalyzed properties that I get sent on I'm going to say daily basis is ridiculous. Deals which are, going back to, I know a lot of you have seen my deal analysis lessons in Blue Oak and lectures in Blue Oak, where you've got to be non-emotional and you've got to know what it's worth to you at the back end, the exit figures, and you've got to know what it's worth. And you don't buy a property on emotion. You don't buy a property because you think it looks nice. You think it will go up, okay? Yes, if it's a personal property for the rest of your life, yes, buy it on emotional. You want to buy something that you love. But if it's an investment property, you buy it on the numbers, on the facts. And people are underanalyzing deals right now, and they are jumping in them thinking, actually, I can buy this. If I could push it just a little 5% more and I get this deal, that's fine, because it's going to go up that 5% because it's just gone up the past 20% in the past 5 months. Okay. So what I'm getting at here is people are becoming complacent. Complacency is creeping in. And don't get me wrong, I never saw the property market doing what it's just done for the past 6 months. And, you know, don't get me wrong, if you bought in March and you are where you are now and the market subsequently drops, it's dropping from a higher level. So it may actually, you may still be in profit. But the analysis of everything, of stocks, of shares, of property, people are becoming complacent. So I think sign number 5 is a categoric tick in the box. Those of you who saw my post actually the other day, just while talking about property, on that, when I took speculative income and bought a property for 40 grand, I went back in with her and offered 35 and she settled on 37. So for me, the principle of just saving myself there another 10% by taking that from 40 down to 37. Why was that? Because the tenant in there I'm going to have to deal with rather than the seller. She won't do it on vacant possession. But what I'm getting at there is that analysis, once I analysed that deal a little bit more, part of that analysis was the tenant. What was the cost of me dealing with a bad current tenant in place? I went back and renegotiated that price. It's 40 grand property, but it's not the point. So hence I offered 35 and we've settled on 37. That gives me 3 grand to get rid of her. Why? Because I can't do anything about her at the moment. So I've got to live with her until the ban of evictions ends. That's another story. That's another story. But what I'm getting at is analysis. Don't get complacent. You must do your figures and stick to them.
Why not offer 2 grand to leave?
It'd probably be the quickest way, if I'm brutally honest, Marcus, rather than going for a formal eviction. Yeah. Money printing, okay? It's not stopping, okay? So these were put together by Ray Dalio when he first read his book. So it's interesting that he's talking about the money printing of both American, not so much in the UK, but we are still doing it significantly. And I do see it potentially increasing again once a few things. So obviously the help out to Eat Out to Help Out ended today. Today was the last day. A lot of restaurants are going to continue it out of their own pocket because obviously they've seen footfall increase. But I think that's going to be an interesting one moving forward. But certainly we've got record low interest rates. And I say in America, they're already going to try and do controlled inflation. If those of you saw Powell's speech, if you haven't seen Powell's speech, go and have a little read about it. So obviously Powell in America controls the Fed. Have a little read about that. All of this, guys, I know for those who are new are thinking, "Right, I'm lost. I'm bored. I don't really get this." What I'm trying to get across to you is actually, if you're looking at these signs, when you start looking at the economy as a whole in the future, or the property market as a whole in the future, or stocks and shares, and you can think, actually, do you know what? Half of those signs are starting to ring true. Everyone's talking about this because we're in this right now, okay? But we won't be in this in 2 years. People have short memories. So what I want you to do is store this information at the back of your head so that in 10 years' time, okay, when I've retired on my small Caribbean island and all of a sudden signs 1 to 6 start rearing their heads again, you can think, do you know what? I remember there were some signs that Ray Dalio wrote in the 60s that Rich drew my attention to in 2020, and they're all happening again. What was that? It's a bubble. Right, what do I want to do about that now? Because people have short memories. People will not remember in 3 to 5 years' time what is currently going on right now. So stored away at the back of your head, like a little bit of knowledge, a little bit of education, that's in there. So to conclude on that, it seems that most of those signs are in existence at the moment. Okay, doesn't necessarily mean that there aren't opportunities, and that's the key. There are opportunities. Okay, those of you who've taken my share tips right now, if you stuck with them, are you're certainly into double figures up. I wouldn't like to say much, but you'd be in double figures up. Now, if you think of being double figures up in that period of time, that's better than you would ever do, because there are opportunities. I've just opened my eyes to those opportunities, and then I'm communicating them to you. There are opportunities in the property market, as well as the share market, as well as a number of other markets. You've just got to be aware of them. So a few ones to watch. Okay, and then I'm going to, a few ones to watch. Okay, so here's a little one. None of these I'm buying into, but they're ones to watch for you. Upwork. You've all heard of it. Okay. I see it getting bigger because of again, what's going on, of furlough coming to an end. They are pivoting quite a lot at the moment. So it's one to watch. Okay. Yeah. And I think that's it. You know, current workspaces being disrupted. People are not going to go back to large office spaces. People are going to be working from home a lot more. And it's a platform in order to allow them to pitch for further work. So Upwork is certainly one to watch. The other ones really at the moment, I'm starting to become a little bit more defensive when it comes to shares. So I'm more looking at your longer terms. Now, I mentioned Visa a while ago. And again, Visa will fall into the long-term hold pot, along with Tesla. Apple, I had Apple, but I've never, when I say I had Apple, I've had Apple in an old ISA account, which I haven't touched on. That hasn't been a new purchase during this thing. My Apple is very, very old. I haven't got many of them. I think I've got about 20 Apple shares, not a lot. But I might add to Apple, very similar way that I've just added to Tesla. Those two for me are just your long-term stalwarts. They're kind of your child's ISA. If you've got a children's ISA, you know, don't fill it with them, but certainly to have a portion set aside in something like that. If you've got kids of, say, 1 to 6, of that sort of a range, where they're going to have this for that you can't touch for the next 10 to 15 years, they're kind of good stalwarts in there. Visa for me is another one of those. With the way fintech is going, so fintech being financial technology is one of the massive growth sectors, especially with going to digital currency, which the world is going to go to. Whether that's into crypto, again, we'll have a crypto chat one day, but that's why I like Visa, and their technology is phenomenal. It's about 190, I think, at the moment. Pays a good dividend, hasn't cut its dividend. It's a good stalwart, but don't be buying it at 190 and looking at it when it moves $5 up or down. It's a put it in there and forget about it. So that's why I refer to them as potentially kids' ISAs ones, because it prevents you kind of tinkering with it too much, shall we say. So that's those through. Speculative, FBIO, right? So which is Fortress Biotech. It's a right, let's roll back to what I said at the beginning, where I said you will have one that'll hit the roof at 3,000%, but you'll have 99 that'll crash. It's very much one of those. But if I was going to put my money into a biotech company, it would probably be it. There's a little bit more reading I want to do about it. I've read quite a lot about it. I'm not at the point of pulling the trigger yet, shall we say, but it's on that radar. How I would play that is, let's say, so at the moment, I'm very open and honest with you guys, is I'm kind of running out of funds in my ISA accounts. I've allocated a lot of them around. So how I would play FBIO and Apple and Tesla being the stalwarts to put away is, if Rocket jumped on Wednesday and I jumped out of it, I would then potentially allocate a very small portion, and I mean very small, to FBIO. However, I'm caveating that with I still do need to do some work. So it wouldn't be jumping straight in on Wednesday, but I'd potentially allocate in the account, right, I'm allocating X number of pounds to potentially an FBIO purchase if I decide to make it. I may then allocate some others to Tesla and Apple, and I may then hold a portion back to potentially get back into Rocket, depending on its price action post Wednesday. So do you see how I play that? Do you see kind of the way I map that out? It's not just a binary in, out, here's my money, go. It's actually well thought out. So it's a case of the allocation of those funds. So that's that one. And the Japanese move, right. Those of you, so in the press this week was the fact that, again, good old Warren had bought 5 Japanese shares of around 5 billion, I think he invested into them. Mitsubishi, I've got the articles actually, if I can close. Let me just try and close. So, or maybe I haven't got them open. So there's what, so Buffett just bought these companies here, if you can still see that. So the only one that most of you have probably heard of is Mitsubishi and the others. Now, that was announced, when was that announced? That was announced 31st. So it was announced today. What you've got to remember is those holdings are not made today. They were made on his return that he has to file for public offerings. So when they're making such large purchases in America, they have to file a public report, and it can take up to 3 months for that to become public knowledge. So if you go on and you look at like a Tokshu share price today, it's pretty crap. As in but if you look at it between now and 3 months ago, it's done well. So a lot of people will blindly follow people like Warren Buffett. They'll blindly follow this advice. But what you've got to remember is there's up to a 3-month lag on this, okay? But what is of interest? So what I'm saying to you is don't go and blindly follow this. If you love him, and don't get me wrong, I love him, and you should be investing in just parking money in Berkshire Hathaway shares. But what I'm getting at here is when you see some of these large American players like your Buffetts, you know, and a lot of the others, there's a lag in them hitting public records and when they actually physically made the purchases. So ensure that you go and have a little look at the share price and actually look back between now and 3 months and see what happened. Quite often, they've risen for quite a lot in that period of time. But also, you don't know what they have seen in order to buy them. And even though you could probably blindly follow him, don't, unless you understand the ins and outs of it. But the reason I wanted to talk about Japanese shares is back in March, I read an article by old Michael Burry. Michael Burry is your man from The Big Short. So he was the man, and he's an interesting one. If you want to look at what people are doing, okay, Google what Michael Burry's doing with his current portfolio, watch YouTube videos about it. He's one of those players that's very, very interested. Now, this was written on the 16th of March, as you see at the top here. And lo and behold, in March, Burry went and invested in a handful of smaller, handful of smaller Japanese companies. Okay, now at that point in March, I started researching Japanese companies. Okay, so when people ask me, how do you research a company and where do you start? And part of that is it's like anything, you've got to have somewhere to start. Yeah, I could give you all day and say, right, you go and look at it. I guess it's one of those things like I could sit and write a bullet point of what to look for in a company, starting with debt levels, PE ratios, etc., etc., etc. But the key point is you've got to know where to start. Otherwise, where do you start? You start at A and work your way through to Z and look at every company. You've got to kind of look for those signs to give you a little bit of guidance. So what I did, I literally will just read all articles. I just generally read around the subject and little things will jump out at me. And that was one of them, small Japanese companies. So I started to research Japanese companies and I started with the ones that he bought. It's why he bought them. So this is the current Japanese market. it took a much, much bigger plunge than anywhere else in the world, and it still hasn't recovered. And these are the companies that he entered into. Tasmo, which is a construction company, Kanemoto, and Alltech. Yeah. And they have all, I think he's done about 30% pretty much on every one since March. Now, you don't know if he's still in them. I look at the share price today. I had a little look today once again. It's not something I would be potentially investing in now. When I did the research in March, I probably should have pulled the trigger on that because I read it. This gave me where to research. So this was sign number one, right? I now know where and what I'm going to research. I'm going to research these three companies, and I'm going to research the Japanese sectors that they are in. And I did a little bit of reading of it. Probably no more than 2 or 3 evenings worth of reading. And that was that. I didn't do it though back in March. But then when I read that about Warren Buffett, it kind of sparked me to think, bloody hell, how interesting is that? That another one of the major players in the world has gone to do it. So all I wanted to get across there is kind of, it's just interesting where we're going in the world.
Rich, what do you see the likely effect of Shinzo Abe resigning as Prime Minister and sort of changes in leadership with his economic reform?
I think the whole, to be honest, I don't know. If I'm honest, I don't know what that's going to do to that entire part of the world. That, and again, I think, I don't know if I'm honest. I haven't looked at anything in that region since I did the research back in March when I was sat in lockdown. Then I've completely ignored kind of their shares and what have you. I do see anything like that being of that their prices are still in the gutter. So if I'm honest, I see anything like that, any change of leadership over there, potentially having a short term. I don't think it can go any lower, but I think it will have a long-term beneficial effect. So again, pick the right ones in Japan. Actually, you've probably got a good chance of doing well. But it's just one of those of interest. Again, guys, it's just about reading around subjects, being aware. So I guess the only one that you potentially will leave with tonight is maybe if you want to have a little look around Visa, those of you who've got child ISAs. And when I say, as you know why I say child ISAs, because it just means parking it. And FBIO, if you're going to look around I will let you know if and when I jump into that. But do not follow people blindly. I do not want people just following me blindly. You've got to know exactly what you're putting your money into. So I was asked a question on Facebook. Oh no, that was my last chart I wanted to show you, which is an interesting one.
FBIO, Rich, have just released their investors thing today. The new demographics of all the things of what they do and things. I was just
has it gone up today? Has it hit the roof today, Marcus?
Yeah, it's just come out 31st today.
And what's it done today?
No, I was saying they've just released their investors, their updated investors, offering things, saying what they do and things.
Okay. I was going to say, I wrote that last night. I was like, bloody hell, I hope it hasn't already hit the roof.
It's done 5% today.
How much?
5.3%.
Oh, that's, yeah. Don't get me wrong, it's not bad, but it's not. It's still, so a move like that is still what I would class as fluctuating. Yeah, so it's like rocket at the moment, it's fluctuating. It's sitting waiting for that news. So what this is, guys, is I spoke a while ago about M2. So M2 is what's called money velocity. Money velocity is the physical money transacting, okay? So when you, and this is why some of this went wrong with the global pandemic, is if people, when they were stuck at home, were actually hoarding their money because they didn't know what was going to happen. So by hoarding that money and saving it, they were paying down their personal debts. Lo and behold, that's what we've seen. Personal debt is drawn down. People have been buying on Amazon, yes, but actually, and people think, oh, well, everyone's spending because they're buying shitloads of parcels are getting delivered and again, but actually as a percentage of all of the other spending that's not happening, actually there's not. So that individual is buying on Amazon, yes, because he's sat at home bored, but they're not going away on holiday. They're not going to hotels. They're not spending money in petrol stations, driving up and down the country. All of that expense stopped. So actually the velocity of money, the amount of money being transacting suddenly slowed down. Okay, now that is the red line. So the velocity of money has actually been deteriorating since, well, as you can see back since 2020, it's been slowing down. And if you look at each recession, it took a very large dip. But where we are now, you can see it's really, really hit the floor. But as a result, but what's happening is we're printing more and more money. The reason they're printing more money is to try and get people moving, get people going and going and going. And as you can see here, we've got this massive delta, this massive gap. Yeah. And that is just a sign. So it's a gap in the wrong direction, i.e. blue above red. And that's just a sign of effectively that we are inbound for inflation, which I think we all know. It's like one of those things that you put it, you say it and everyone's like, well, that's obvious. Well, a lot of it is obvious. It's like, I put a thing up about corporation tax the other day, that corporation tax potentially may well go up. And everyone's like, well, of course, everyone thought that was going to happen. Yes, but to understand why is the critical thing. We all understand that inflation probably is going to happen, but tell me why. And the reason why is because actually, oops, Daisy, why is because the velocity of money, the physical spending of money, and the physical amount of money that's currently in circulation has, the delta has become too wide. Okay. I just wanted to leave you with that one. Before, I spoke about a question from Ash Anderson, if he's on here. So Ash asked me about, in fact, yeah, that's interesting. So helicopter money and UBI. UBI is an interesting one, universal basic income. The government just paying you. They're doing it in a lot of countries at the moment. Qatar is an interesting one, if anybody's ever been to Qatar. So in Qatar, every individual gets £2,500 per month off the government as a universal basic income. Ridiculous. Ridiculous. But there we are. If you haven't or don't understand what universal basic income is, there's a little Google bit of homework for you. Go and have a little read about the effect and the power of a universal basic income. So Ash asked me about the silver and gold ratio, okay, and why I was more pro silver at the moment than gold. And I've said it a few times, and again, I apologize that sometimes I say things like that I play the ratio, is how I kind of term it, and expect you to understand. So I do apologize for that, guys. And if I come out with terms like that, please then do say to me, I've no idea what you're talking about, right? Which effectively is what Ash said to me. He was like, right, tell me why you're more bullish on silver right now than gold. And the simple reason is the ratio. Now, this isn't for everybody, okay, to do this. So I do this because I understand it. And the key is the understanding. So hopefully by the end of this, you will all understand it. But some people would rather just buy gold and hold it. Now, the key is gold is what is the main currency, is what you want. The more gold you physically held or hold, the better. The other ratio I play, for those of you who are into crypto, is the Bitcoin versus Ether ratio. And it's exactly the same principle as I'm about to go through here. So here on the screen, you've got the silver versus gold ratio. And as you can see, it's been dropping there since about 2017. And then it spiked at the beginning of this year. So it dropped and dropped and dropped to the point where silver was radically undervalued because the world was living in this boom period. So what happens is silver is an industrial metal, you know, it's used in drill bits, it's used in all sorts of circuit boards, etc. It's an industrial metal. Gold is a store of value. So actually what happens is it drops and drops and drops in price because it's being used a lot more until the point it needs to be used as a store of wealth again. So as you see here, beginning of the year, we had a massive spike in the ratio. This is not the price, remember guys, this is the ratio. And it spiked up here to 0.14. So you might look at this and you might think, well, Rich, if it spiked here, I don't get what you're looking at here. I don't get what you're looking at here. So now let me explain it. And I was going to try and do this live on screen, then I realized the maths would be ridiculous. So I had to do it as a PowerPoint slide. So what we're going to do is we're going to take 1469. So £1,469 today is what 1 ounce of gold will cost you. 1 ounce of silver will cost you £20.80p. Okay. So I'm going to buy, instead of buying 1 ounce of gold, I'm going to throw that money into silver. So I'm going to buy 73 ounces of silver. So now I hold in my hand 73 ounces of silver. Forget about the money, forget about the ratios, forget about everything. I hold 73 ounces. That's what you've got to remember. Okay. Today's ratio is 0.014, okay, here on the graph for silver to gold, or 71 for gold to silver. Okay, forget about that second line, but just look at that top line. 0.014 is what it is today. And I have in my hand 73 ounces of silver. Now, let's zoom out a little bit. And this is why it's important. Don't just look for the past 5 years and things. You've got to look back in history. Okay, so let's look back in history. Okay, so now what we're looking at, this section here is what I just showed you on the previous graph. Yeah. Look where silver once was. Okay. Now, actually, if the world in its current state of affairs continues and moves to a digital currency, the chances are this graph will start tracking back up here. Okay. We don't know how far it will go, but let's say it gets to, I don't know, not even the highs of 2012. Okay, but it starts to rise because of all of the other factors in the current global economy. So remember, I hold 73 ounces of silver. That cost me 1,469, which was 1 ounce of gold. Forget the monetary figure, but the ratio starts to rise. Now, let's say that ratio gets to 0.025, which is here. I then transfer my 73 ounces of silver, forget about the money. I then transfer that to gold. 73 ounces of silver to a bullion dealer will multiply it by the ratio, which is 0.025. I'm being conservative if it gets to here. He will then give me back 1.825 ounces of gold. So I've just created 0.825 ounces of gold by playing the ratio. Does that make sense? No? Gary, you're the only one.
How you doing?
Yeah. So I've played the ratio and I've created out of nowhere nearly another ounce of gold. And then gold is what you'd sit on and hand to your grandchildren who will hand to their grandchildren.
Rich, what changes the ratio?
What changes the ratio is, it's the use class, so it's where it's being used. To be honest, what changed it is just that supply and demand factor. It's where people are piling their money. So it's like your share split at the moment with Tesla. People can't afford $2,000, yet they can afford once it's split down. So people can't afford the 1 ounce of gold, so they might throw it into silver, and that drives, it changes that ratio. There's a lot of factors, if I'm honest. Ash changed the ratio. The industrial use changes it as well. What it's being used for in industry changes, but it's generally once things start to become a store of wealth, the ratio narrows.
So on this graph then, you want to buy it when the ratio is low. That's right, isn't it?
You want to buy it when it's lower. So if you bought it last year, okay, so let's say you bought it middle last year, but then buying it middle last year, nobody really saw. What you want to do is post a spike like so, a lot of like very wealthy investors will be cost averaging all the time into silver. But do you really want to do that? Because it's a non-leveraged asset, so you can't leverage it. So you're parking money. And that's what you've got to remember when you're buying precious metals. You can't leverage any of this. So when you're buying, and that's why property is such a powerful vehicle, because it's a leveraged asset. Yeah. So none of this, if I wanted to buy gold and stick it in my cupboard, I'm effectively, all I'm doing is I'm protecting myself against inflation, but I'm still parking my lump of cash in my cupboard. Yeah. which is why you need a fully diversified portfolio. You need some of it parked in your cupboard, but you need some of it income producing in a leveraged asset, i.e. property. None of these things should be taken as standalone things. They all need to be working with one another. They all need, i.e. your gold, your speculative, your shares, your ISAs, your property. If you just pile it all into one, I'm quite sure you will become rich, but you won't become wealthy. You say that's the difference. So yes, Ash, to answer your question, you want to be buying it when it's as low as possible. So what happens is, at the moment, we have hit a spike, 100% we've hit a spike. What also changes it, and one of the biggest factors, is the strength of the US dollar. So I see silver and gold actually weakening at the moment for the foreseeable, probably again until the election, because the US dollar has picked up a little bit of strength. But when the US dollar as a currency starts to weaken again, both the ratio will increase and the price will increase.
Rich, do you have a target for selling your silver set at the moment?
So, right. So if I put a target on silver, I'd sell that at double its value, which was £40 for me.
Right.
Okay. But if I'm brutally honest, I won't probably sell it. Yeah. But I might, it's one of those things that, but again, it's understand, and you know, like I say to you all, you've got to have a target, you've got to have an exit. So when I bought silver, when I hold physical silver, it is at 40. Okay. Will I do it then? I don't know, but I'll reassess. So what it does is it drives a line to actually, okay, I need to reassess what's going on here. But that's the ratio. Does that, Ash, obviously I didn't see you on there because I can only see a few thumbnails. Does that kind of make sense about why I play a ratio?
Yeah, it does, Rich. Yeah, nice one.
And I'm doing exactly the same at the moment with...
Understand, sorry, how you play it to leverage it and to then transfer it back into gold long term. I think when I shook my head, as I didn't understand necessarily what the ratio represented, but would I be right in saying if there was equal demand for silver and gold, then the ratio would be 1, it would be on parity?
I suppose theoretically, yes.
Okay, so silver's worth a percentage of what gold is, and what you're leveraging is how that percentage of representative value changes over time.
Yeah. So you're just trying to create it out. You're trying to, so what I'm done here is kind of you're trying to create it out of nothing. Now, this does not work for everybody's mental mindset picture. Okay. You just want to go and buy the store of wealth. And that's why a lot of people will be, I'm just buying gold. Because if you get this wrong, okay, if you've got, and again, you've got to look at what your intent is. So my intent with silver is to transfer it to gold. If my intent for silver was a short-term play, okay, like I said, their target to sell at 40, okay, maybe I wouldn't be concentrating so much on it. Yeah.
Rich.
Yeah.
Is it worth talking about the difference between certainly VAT on silver, no capital gains tax on it if you buy a Britannia, which becomes a £2 coin if you buy in silver bullion. Just to sort of explain the differences, certainly what you're buying in, 73 silver ounces at 20 pence or at £20, that didn't include the VAT, did it?
Yeah, so that's correct. Yeah, so as Jay said there, if you are physically taking delivery of bullion, then you will pay value-added tax on it. Okay, so you will pay VAT at the current rate. If you have it stored, so you never take delivery of it, then you won't pay VAT because it's being stored by a third party. And what he said there is a very important one about capital gains tax. So like we said about capital gains tax at the beginning on traded income, on bullion, any gain you get in precious metals, you are liable for capital gains tax as well. However, there's a coin, a silver coin, which is called the Britannia coin. So if ever you're buying silver bullion, you know, that's advisable to buy the Britannia. So the Britannia is a £2 coin. Don't get me wrong, it'll cost you like 21 quid each. So it's not exactly a £2 coin, but it's got a face value of £2, which makes it legal tender. And if it's legal tender, it's then void capital gains tax. So all you're doing is you kind of, again, playing the tax rules. So you void capital gains tax if you own a Britannia coin. If you take delivery of it, however, you're paying VAT. vice having it stored where you wouldn't pay VAT. So
VAT because it's precious, because it's an industrial metal. Gold does not. Gold doesn't.
Yes, sorry, yeah. So gold, I just said, yeah, gold you don't pay VAT on. So, because, yeah, silver's classed as industrial, not precious. So all of that does come into play. Again, to trade and to hold precious metals is almost a separate entity. You know, I hold for the long term, and I know some people there, like Jace, you hold, you've got sort of certainly a number of these and other assets that the plan is to hold for the long term.
Absolutely, mate. Yeah.
Yeah. I mean, Jace's got a good story where he bought a car with some.
Yeah. Another time, perhaps. Yeah.
For another time. But yeah.
But I sold those in 2011, 12, when gold was certainly perhaps 2 or 3 times more than I paid for it.
Yeah. So it's kind of one of those things. It's look at always. It's like I say with everything. Certainly with those lads who follow me on Blue Oak, it's the exit in mind. Have an intention. Have an idea of what your exit will be. Okay. If the exit is to just put it in a cupboard and give it to your kids to play hookers with when they are 21, then that's fine. That is at least an exit, okay, to hand it to that next generation. If the exit is to transfer it to gold as a store of wealth and put that away, have that as an exit. So, you know, to give an impression, when I've talked about silver on these, my intention for silver is twofold. I will reassess when it gets to $40. Okay, so when it doubles in that value, I'll reassess when it gets to $40 and either sell, depending on what else is going on, if there are other opportunities that present themselves, or if the ratio allows, I will transfer it into gold and hold for the long term. Yeah.
The problem was, so Rich, just talking about ratios and changes, a lot of people said that platinum wouldn't be less than gold 5, 6, 7, 8 years ago or so. Now, funny old thing, platinum then was superseded by gold, and no one really knew why. So it's just a case of doing your homework, I suppose.
I suppose that's true. I've never really looked into platinum, if I'm honest. And you know, I don't know whether you have. I certainly haven't.
Yeah, so platinum in 2012 was worth more than gold.
Yeah,
and it's always worth more than gold because, of course, I think the way they looked at it was if you know the amount of gold on the planet, there was like 5 swimming pools worth, if that makes sense. There was less swimming pools worth of platinum. There was about 30 or 40 swimming pools worth, full Olympic swimming pools worth of silver and bronze, etc. So they all come down in that there's a lot less platinum on the planet than there is gold. But it appears because of quantitative easing or, you know, sort of global recession, gold became the gold standard again over the past 10 years versus platinum. So it's a bit unexplained why it done it, but platinum is a lot rarer and traditionally worth more than gold. So I'm expecting platinum at some stage in the future to be worth more than gold, but who knows when. It should do, but it hasn't.
Yeah, I mean, theoretically it should because of its rarity, but obviously...
Yeah. So same as silver versus gold, why silver hasn't climbed to what it should be versus gold. And, you know, the bullion dealers are a little bit flummoxed why it isn't worth $50 an ounce as well.
Exactly. So. And I think it will be. You know, it is one of those things I think it will be. Yeah, I think it will be. But it is about having that intent, guys. So, you know, if you are into this in storing, it is that store of wealth. Have an intent. That was it. That was my last slide.
Rich, can I ask with the gold, with that, is that a physical gold?
So I do. I physically hold, yes. Yeah. Okay. I physically hold and have it in the house. And again, that's a consideration, don't get me wrong, because you've got to look at the amount of storage space. So if you do physically hold silver versus gold, you know, I wouldn't, you know, again, you've got to consider that they're not, it is very, very key that they're not, you've got to understand that they're non-leveraged assets. And that is very, very important, that you can't leverage them at all. Well, I mean, you probably could to some extent, but they're non-leveraged assets. So you're not going to be piling everything into it. It's very much it's a small play. But yes, I hold.
Yeah. All right, great, thank you.
Rich, there was a slide earlier on in the presentation said about coming back to about analysing companies.
Yeah, did. Gary, that is my own fault. So it's about three questions. I'll tell you why I didn't come back to it, is I wanted to add a lot more detail in it. Which I think what I'll do is I might do it as a live, to be honest, into the Facebook group, because I don't want to do it. But there's three critical questions. And the reason the three critical questions really are the starting point of analysing any company. And it's where it makes its money. Is it any good at making its money? And could the prices be increased without the customer knowing? And there were three. And what I say there about where it makes its money is and that's what I wanted to put a few more examples in, because it's like the Airbnb actually makes its money in advertising, not what people would generally think it makes its money in. And there were a couple of other examples which I wanted to write about and put in, which are not what you think. They're not what you think on the face value is not where it makes its money. And actually, if you don't understand where it actually makes its money, then actually you're going to be far, well, you shouldn't be investing it in the first place.
Yeah.
So, let me just mute you. I was come off mute. There we are. Let me just quickly open that. There was two. Right, so there's only, it's slight venture capitalist. Yeah. So share, again, talking Tesla, saying why, so one of the questions, why would now or tomorrow be a bad time to buy these shares? So theoretically, on paper, those companies need, any of the FANG companies, okay, Facebook, Amazon, Netflix, Google,
and Apple.
I knew there was another A. I couldn't think what it was. They're not theoretically worth what they are currently priced at. They are in a classic bubble, but they're tech stocks. They are, which have and have all gone beyond the theoretical values on paper. So you ask why. It's a difficult one because I look at them theoretically and they're not worth what they are. But that's exactly what I did. And, don't get me wrong, I am sat in a position where I wish I'd invested. I had Tesla on my radar when it was at 400 and I had a buy at 280 was where my buy was. It was began with a 2. I was being bloody greedy. Okay, and now look what's happened. It went from there all the way up to 2,200. I look at the share split now, that's just happened, and I see it spiking in the next few days because all of these other retail investors will be jumping in the market. Now, half of me says I will get out when it spikes up by, say, 15%, potentially 20%, but that is a foolish thing to do. I'm in it for the long term, end of story. Now, if you, it's one of those things I cannot recommend that you do that because I don't see it holding its current price, but I also didn't see it getting to 2,200. They have all defied logic, quite frankly. But I do see the whole market rolling over. I do see the S&P, I see the NASDAQ, I see the FTSE. The FTSE's actually already started to roll because we haven't got the same amount of quantitative easing. But I also see the FANG stocks not really being affected by them. So to answer your question, why would now or tomorrow be a bad time? It's not. If you like the company, like its future, then invest in it when you see fit. But again, I would potentially not put all of your eggs in that basket, put 50% in or potentially a little bit more and price cost average, whether you do that down or up, cost average in. Okay.
I think a good point that you brought out on your one of your emails, Rich, was a really good and valid point about wishing that you were out of a bad share. Vice, wishing that you was in a good one and being stuck with it. So think people just need to be sort of a bit cautious, certainly this time.
Yeah.
Play.
And that's kind of what I said about I'm becoming a little bit more defensive, shall we say, on it. So, I'm looking at your Visas, your Tesla, your Apple. They're kind of the stalwarts. You can put them away and you can forget about them. You're speculative there. You're like your Rocket Corporation. Am I a long-termer? I think that's, like I said, with Rocket, you've got to look at what its fundamental core business is. It's boomed at the moment and it is booming. But actually, do I see mortgage delinquencies and debt delinquencies increasing in America? I do, which actually could well damage that. Do I want to be in that one and holding it for the long term? Maybe not. So what I'm getting at there is I may reassess that price target that I put out. Like I've said to you, on Wednesday, if it spikes, I may well get out there and then. So you've got it, but I'm looking less at the very volatile, speculative ones at the moment, because I just think I feel this bubble is getting to the point of ridiculousness. And like I've always said, I think the US election will hold a lot of weight in the whole affair. And obviously this whole second wave blah, or, no matter what you feel about it, to be honest, but that's a big thing. Actually, if the country suffers again, you've got a number of things. You've got the Eat Out to Help Out, brilliant thing by the Chancellor to get people moving, but obviously it's expired today. You've got the furlough scheme coming to an end at the moment, non-extended. If he extends that, that changes the playing field, okay? But you've got that not extended. You've got the US election coming up in November, and you've also got the budget coming up in November, where he has to try and reclaim some of this money. So there's a lot of things happening between now and the end of the year, which I don't particularly want to be overly exposed in some areas of the stock market or the property market. Okay.
Rich, why do you think he has to do something in the budget to reclaim what they've spent out? Because obviously if he bumps up corporation tax, it'll be the death knell for some extra companies that probably were teetering, isn't it?
Yeah. Well, why do I think he's got to do something? They've got to get the money to pay down the debt from somewhere. They can't just sit on, an increasing national debt and a GDP, which is probably increasing now because obviously everything's open. But there's got to be some movement to pay back this debt. Do you know one of the biggest things I think they'll probably take a hit? I think the military budget will take a hit as well, which is an interesting one, having just, stepped out of that. I think that is if you look at, NHS, military and the other large pots, the military is not doing anything. We've been heavily invested in Afghanistan for the God knows how many years. We've now had a quiet couple of years. Is that going to be the area that takes a, who knows? But I do think the Chancellor will need to do something. Where it comes from, nobody knows. Yeah, where it comes from.
It won't come from MPs' pensions, will it?
Yeah. Come from doctors and high-rate taxpayers, tell you. That's where it should come from. Only because I'm a non-high-rate taxpayer now. Pay yourself in dividends. There we are. Guys, that's another one. One of the questions I did get asked was about tax. Okay, now I'm no tax expert in how I move my property money about through intercompany transfers, then personal loan it back to myself. It's quite a complex subject. I'm not a tax expert, so therefore I can't really, again, it's one of those things that I'll talk about how I do it and how my accountant does it for me. But that call can kind of not expand beyond that, if that makes sense, because I know what I do, I know what she asks me to do, and then we do it. I move money between companies into company transfers to save a lot of money, which is what we do with tax. I pay myself in dividends only to save on money. I'll talk about that on another evening. I'll do a one really looking at how I move my money around that triangle from speculative down to the next tier and then into the property tier. I'm no tax expert. So that's it. It's one that I don't really want to delve too deeply into. But other than that, I think we're at 8:30. We're an hour and a half in. Hope that was useful. Hope people got a little bit of value out of that. Those of you who are in the rocket, Wednesday's your day. I will drop in whether it's after hours or after Tuesday's hours, Harry. So it's whether it's Wednesday trading day or whether it would go into Thursday's trading day.
Afterwards, it's at the close. It's definitely afterwards.
Is it? Yeah.
Yeah.
There we go. So it's Wednesday after hours. That announcement will be made. So if you use a platform like Yahoo Finance, will show after hours trading. So it means that when the results are released, you'll be able to see if it spikes after hours, okay, or if it hits the floor after hours. Yeah. And then obviously you can do bugger all about it till it opens the next morning. But at least you know where it's going to potentially open. If it spikes down, you wouldn't sell. I would wait for it to recover. Whenever there's a spike, okay, so here's a bit of what's called price action. So when you're looking at price action, whenever there is a dramatic move, either up or down, the market will generally retrace a minimum of 50% of that move. So if you have a price of, say, £100 and it has some news and it spikes up by, say, 30%, or some fake news, i.e. your boohoo piece, fake news, okay? So it spikes to 30 to 130, chances are it will retrace to a minimum of 50% of that move. So it will retrace to 115. And that's exactly the same if it spikes down. Let's say there's some bad news and it spikes. And when we're talking spiking, we're talking moves over the course of about an hour. So we're talking very, very sharp critical drops. So let's say it was £100 and it sharply dropped to £70. Okay, chances are it would minimum recover to £85 before the news really, before people then looked, is this news real? Is this news false? If the news was real, it would sit at around that level. That's called price action movement. And you can use that for those traders, okay, when we talk a little bit more about trading, that you can short or you can quickly long a stock if you look at rapid price movement. I don't recommend any of you do it, but that is the reason I may sell come Wednesday if we see a rapid jump in that after hours trading of around the 20 to 30% mark. I may, and that is a may. It really depends on what those figures are. If those figures are categorically unbelievable, and that spike isn't just a spike, it may spike and keep going. But again, you've got to look at your intent. I don't intend to hold it long term. Yeah. I'm not going to get back in it once I get out of it. Once I'm out of it, I'm out of it. That's it. So those of you who had FOMO say about Arrow, if you're out of it, you're out of it. Don't get back in it unless you can find that entry point back in it. Don't get in anything for FOMO. There will always be another. Yeah. I think that's about it, really. I think that's all I'm doing, really. The other one I'm currently squirreling a side pot to is, like you know, is I'm still going on the crypto side, and mine's going into Ether. Why Ether instead of Bitcoin? I want to hold Bitcoin ultimately, but I'm playing the Ether Bitcoin ratio. Simple as that. Yeah. Other coins, I wouldn't really get into talking about. I don't research. I did and I have, but I don't anymore. The field is too vast, but I do see the finite supply of Bitcoin making it quite a valuable asset in the long term. But that should only ever be a very speculative percentage of your net worth. Do not just go all in thinking this is going to be.
Did you say that Bitcoin was going to go down? You said that it was going to retrace, in your opinion, to about 10.5.
So, well, again, but that's following a chart. So if you look at the chart pattern of Bitcoin, so just 2 seconds. Have I got a chart of Bitcoin handy? 2 seconds. And I say, okay. 2 seconds, let me. It won't let me draw lines on it. it won't let me draw lines on it. What, if I'm honest, it's one of those things that I just cost average. I just regularly will put money in, okay, through my account. It's the thing with any cryptos, and it's like anything, that you could wake up tomorrow and Bitcoin will be 6,000. Okay, it really is that volatile. But fundamentally, long term, I see its value, and I see that it's fundamentally got a lot of legs. But if you went all in, for instance, and you woke up tomorrow and it was 6,000, you just halved what you'd just gone all in on, the chances are it would break mentally 90% of people. 90% of people would just be like, sod this, I'm getting out, because I'm just cutting my losses and I'm running. And that's human nature. And that's why you shouldn't be going all in. Okay, if you put in a small percentage and understand why you've done it, okay, and understand what you believe are the long-term benefits of it, and it went to 6,000 tomorrow, mentally you should be able to hang on to it. And it's a long-term play again. I just see the finite supply. I see the world waking up to it. A lot of funds now buying into it. I see it as an as a inflation resilient asset class. You are physically, you don't own a coin. You don't, as in physically have it, but you do own it. It's obviously on a key. There's both sides of the fence. There are those who fear it will go to zero and it's got no worth at all. But actually, you look at a lot of the people who were saying it's a lot of the large players, and again, a lot of the large investment funds and large investment people, say back in 2012 when it hit $20,000, a lot of the people then who said this is absolute crock of shit, it's going to go to zero, and then obviously it did drop. A lot of those people now are changing their minds and changing their tune and actually coming on board with its future potential. So that's quite interesting, the fact that a lot of these major players are changing their minds and changing their tunes. So there's a lot of fundamentals that say it's a store of wealth. Is it going to be $500,000? Yes, you can go and find a video on YouTube that will tell you it's going to be $500,000 a coin and justify why it's going to be $500,000 a coin. You can go and find a video on YouTube that will tell you why it's going to be zero within 12 months. So there's both sides of that argument. So you've got to really be comfortable in any cryptos with why you're getting into it. And critically, it's not going all in. It's a speculative play. I'm probably a little bit more in than I was 5 years ago, but I'm now very concentrated on two elements. 5 years ago, I used to play the altcoin market, thinking I was going to be a millionaire overnight on the 3,000% rise that some of them were making. So I'm very focused on where I'm putting it, and I know exactly why I'm putting it into those two coins. There are some people who do very well out the altcoin market, but there are also 1,000 people who lose the shirt off their back. And obviously you don't hear about them. The only ones you hear about are the ones who've made it, who've struck it big. So what I'm getting at there is if you want to get into that market, very much the stores of wealth are your Ethereums and your Bitcoin. Anything beyond that, there's some fantastic ones like your Ripples, like your Link coins, like those ones, which are fantastic coins, but you've got to research them. Like anything, you've got to research them. For me, I don't research them. I've researched the two, Ethereum, Bitcoin. I'm comfortable with that. Do you know what I mean? So you've got to be comfortable with where you're going. I see Bitcoin as very much a store of wealth, where the other ones are tools. They are tools on like using blockchain technology, etc., where Bitcoin is physically a store of wealth, like a gold. It is the gold of the crypto world. That's me. As I say, that's an area that I'd happily talk about what I do, but I would never advise anybody on that. And that's not me saying it to try and cover my own back. It's just the fact that I don't research the altcoin market. And I don't, I do read about it, and I read about a lot of the moves that are going on, about the security coins, the privacy coins, and all of this, and why they will probably be beneficial. to us in the long run, but I'm not prepared to invest in them. Not for me. Non-leveraged. Remember that. It's a non-leveraged asset class. You're parking your money. I'm all about getting to that bottom tier, having a leveraged asset class for long-term wealth. Yeah. Guys, hopefully that was useful. I will do the analysis of the company's piece on a live. I think that's about it, really. So hopefully you're enjoying the Facebook group. I'm trying to stay engaged in there. There's a lot of good content that is going in there. Please use it. I will keep posting as and when I see things. Those of you who try to do Axie Trader, you know who you are. I'm going to do a video walkthrough of what you need to do for that as a starter for 10, and then we'll take it from there. But I'm going to get you guys on a separate call at some point, so just stand by on that one. For the rest of you, hope you have a good evening. The recording of this will go out if you want to watch it again. And it's been a pleasure as always. Got any questions, please drop them in the Facebook group and I will answer them as soon as I can. Hopefully that was useful. Have a good evening.
Cheers, Rich.
Thanks, Rich.
Thanks, Rich.
Cheers, Rich. Have a good evening.
Thanks,
Bye.
Rich. See you later.